Now we talk about valuation based on comparables. Here is the process that you follow. Select and calculate the price multiple that will be used in the comparison. In other words, if you decide that you are going to use PE, and let's talk about PE because that's what we've been focused on so far. So you select this multiple, it could be another multiple, but we are going with PE, and you also calculate this multiple for your target company. Then the next step is select the comparison asset or assets and calculate the value of the multiple for the comparison assets. For a group of comparison assets, calculate the median or mean, and this is called the benchmark value. Very simplistically, if we go back to the auto example that I keep referring to, your target company is, let's say, Toyota, right? So this is your target company. You identify the other major auto companies that would be classified as peer companies similar to Toyota. You come up with the PE for each of these companies, and then you come up with the average PE or the median PE. Let's say that median PE is 10. This 10 then is called the benchmark value of the PE, because you will be benchmarking or comparing the PE of your target company with the PE of these comparables. Next, use the benchmark value of the multiple, possibly subjectively adjusted for differences in fundamentals, to estimate the value of a company's stock. And this is what I started the lecture with. Let's say that for your target company, the PE is 5. You probably also have, or you should also have, the earnings number, right? So if the earnings number is 5 and based on the comparables, the PE is 10, then what is the value based on comparison? The value based on comparison is 5 times 10, which is 50. Or you can also compare the PE of 10 with the PE that you have of your target company to determine whether your target company is overvalued or undervalued. When feasible, assess whether differences between the estimated value of the company's stock and the current price of the company's stock are explained by differences in the fundamental determinants of the price multiple, and modify conclusions about relative valuation accordingly. So this is an important point. The method of comparables is based on the law of one price. The law of one price says that if all else is equal, then two items should have the same price, but all else is not equal. In the context of valuation, it is the fundamentals that might vary from one company to another company. And one of the most important fundamentals is the growth rate. So that might explain a difference in valuation. Other fundamentals might include different capital structures. If one company is more heavily leveraged, then it is more risky, so it should then possibly have a different valuation multiple. All right, so obviously in this method, a critical element is the comparables. So what are the types of comparables that you use? One is the average or median value of the PE for the company's peer group of companies within an industry, including an average past value of the PE for the stock relative to its peer group. So all this is saying is that you take the average PE of companies in the industry or comparable companies. Average or median value of the PE for the company's overall industry or sector. So rather than just picking some companies from the industry, just having a well-defined peer group, you take a number for the overall industry or sector, including an average past value of the PE for the stock relative to the industry or sector. And then you can also take a PE for a representative equity index, including an average past value of the PE for the stock relative to the index. At times you might just want to compare with the index. A relatively straightforward example is this one, number 12. I'll not cover it, but you can read it if you have time. And finally, you can also compare the PE of a stock, the current PE, with historical numbers or historical values of the PE for the same stock. So this essentially is a time series analysis. All right, next point. Subject company multiple versus benchmark multiple. So remember, the benchmark multiple mostly is coming from comparable companies or the industry. In analyzing differences between the subject company's multiple and the benchmark value of the multiple, financial ratio analysis serves as a useful tool. Financial ratios can point out several things, and again, these are items that you've also seen in FRA, but the core point is this. If your target company has a multiple of 15, so the PE is 15, and it turns out that the PE for the benchmark is only 12, do you immediately say that for our target company which has a higher PE, it is overvalued? Not necessarily. You can look at several ratios to see whether this difference is justified or not. You can look at a company's ability to meet short-term financial obligations. If the company's liquidity ratio on average is better than the industry, would that justify a higher multiple? Probably. The efficiency with which assets are being used to generate sales. If you take a company like Dell and you compare Dell's efficiency with its competitors, is Dell more efficient? It is generally considered to be more efficient. So does that mean that Dell should have the same multiple, or is a different multiple at times justified? So that is the point made over here. You can easily read through these bullet points, but this is a connection, or this is a link between FRA and equity, which is extremely important. All right, I want you to quickly take a look at this, and there's a fair amount of text, but the underlying essence behind this example is straightforward. Read it and then I'll highlight the critical points. So let's look at the main points here. The first one is the choice of the benchmark. In our earlier discussion, we have said that the benchmark could be the industry mean, or it could be the median. So in this industry, we have a very high mean number and a reasonable looking median number. So what do you think is the appropriate benchmark, the mean or the median? Clearly here, the median makes sense, because if you look at the mean, it is heavily influenced by this huge outlier. So when you are using a benchmark, you don't want to use the mean in this context. If the mean and median are close to each other, then it might make sense. But here, clearly the appropriate benchmark is the median and not the mean. Okay, that's major point number one. Next, we are evaluating Verizon. So relative to the benchmark, is Verizon overvalued or undervalued? So we look at Verizon and we look at the PE. So given no other information about growth rates or any other factor, just purely looking at Verizon's PE of 18.3 relative to the benchmark value of 17.3, is it overvalued or undervalued? It is overvalued because these numbers are based on the actual stock price. So the actual stock price over earnings, that ratio is relatively high for Verizon. So all else equal, it appears to be overvalued. So again, all else equal, just looking at these numbers, which stocks appear to be most attractive? Generally, low PEs means that you are paying a low price per dollar of earnings. So assuming all else equal, this looks quite attractive. Quest also looks quite attractive. Windstream also looks attractive. So these stocks with relatively low PEs appear to be more attractive. Okay, now coming to another ratio which is extremely important, which is the PE to growth ratio. Before I go into the details, I'll just tell you a quick little anecdote. When I first started investing, I read a book by a Wall Street legend called Peter Lynch. So he used to write, basically the books that he wrote were for non-finance people who wanted to invest. So he gave several several pieces of good advice, but one important advice that stuck in my head back then was that to decide what company to buy, what not to buy, what stock to buy, what not to buy, an important thing to look at is the price to earnings ratio of a company and to compare it with the growth rate of a company. So he suggested that all else equal and simplistically put, if the growth rate is high relative to the PE, then generally those stocks are good buys. Okay, obviously there's a lot more, but he gave the simple piece of advice. Now he didn't use this term called the PEG ratio, but effectively that's what he was talking about. Now let's look at the PEG ratio. It's the PE divided by growth. So it's calculated as the stock's PE divided by the expected earnings growth rate in percent. The ratio in effect is a calculation of the stock's PE per percentage point of expected growth. Stocks with lower pegs are more attractive than stocks with higher pegs. So if you look at the PE to growth rate ratio, if the growth rate is high but the PE is low, then obviously the peg will be low. So low peg is a positive. That gives you the basic idea, and if you have any confusion, just think about numbers. If a given stock has a PE of 10, that means you are paying $10 per dollar of earnings, but this stock is growing at 25%, then clearly all else equal this appears attractive. But what are some of the limitations associated with the ratio? PEG assumes a linear relationship between PE and growth. The model for PE in terms of the DDM shows that in theory the relationship is not linear. So what does that mean? If you look at the PE ratio based on fundamentals, what is this equal to? It's the payout ratio divided by R minus G. When you look at this ratio, while we do say that a high growth rate should mean a high PE, but is the relationship between PE and growth linear? It's not. Whereas PEG ratio sort of assumes that it is. PEG does not factor in differences in risk, an important determinant of PE. Okay, that's fairly self-evident. And finally, PEG does not account for differences in the duration of growth. For example, dividing PEs by short-term or 5-year growth forecasts may not capture differences in long-term growth prospects. Fairly self-evident. All right. Now we are going to combine our discussion of PE using comparison and going to also look at fundamentals. So if we go back to our telecom industry where we earlier looked at Verizon, so see what's going on here. You are given the same set of industries, you are given the mean and median, and we've established that it makes more sense to use the median number. But in addition to the trailing PE, we also now have the forward PE, we also have growth rates, and we also have betas. So are we given some fundamental information also, some fundamental factors? We are. Okay. Now, which stocks appear to be most attractive based on PEG and beta? So the PEG ratio actually combines two elements. It combines both the PE and the growth rate. So the PE and growth rate is both combined to give you the PEG. So in essence, the PEG does consider one fundamental factor, which is growth, but there are other factors such as the riskiness of beta. So let us now look at which stock appears to be most attractive based on these two. Which appears to be most attractive based on PEG? So if you look at Q, that appears to be most attractive based on PEG. What about this company? It also has I'm going to pick the 3 lowest PEGs. Okay, so 0.78. So these appear to be relatively good. But then you should also look at the betas. Is there a fair deviation in the betas? There is. So T has a beta of 1, which is the market average. Q has a relatively higher beta, it's a 25% higher beta, and EQIX has a very high beta. So when you take both these factors into account, then maybe something like T appears to be attractive because it has a relatively low peg, which is good, and a relatively low beta, which is also good. The curriculum says a lot more, but what I have said here emphasizes the core point that you need to extract from this example. Okay, now some more models, and these seem cumbersome and tricky, but the underlying point is fairly straightforward. On this slide, we'll talk about the Fed model, and then on the next slide, we'll talk about something called the Yardeni model. The Fed model relates the valuation of stocks overall with the bond market. Okay, and you can read this entire text, which has been taken from the curriculum, but I'll highlight the essential point. The Fed model relates the earnings yield on the S&P 500. What's the earnings yield? It is earnings over price. So on average, the earnings coming from the S&P 500 stocks divided by the price of the S&P 500 stocks as captured by the index value. All right, so this is the earnings yield. The Fed model compares the earnings yield with the yield to maturity on the 10-year US Treasury bonds. So let's just call that the yield on the relatively long-term government bonds. Now, what this model says is that the stock market is overvalued when the market's current earnings yield is less than the yield on the 10-year bond. And does that make sense? If your stock market is way overpriced, then what happens to the yield? Then the earnings yield obviously is low. So according to this model, if we have a situation where the overall earnings yield is less than the yield on a 10-year government bond, then clearly the stock market is currently overvalued and should be avoided. Because when you buy stocks, are you taking risk? Obviously there is risk. Despite that risk, if your yield, expected yield on the stock market is less than the yield on a risk-free government security, then you should run away from stocks. They are way overvalued. So that is the essence of what this model is saying. All right, somewhat similar, but a slightly more sophisticated model is the Yardeni model. This slide actually reproduces the entire content from the curriculum. What I'll just do is emphasize the critical points, and when you have time, I do want you to read through that one pager. So here is what the Yardeni model says. It says that the current earnings yield on the market index, which is that same E over P, according to the Yardeni model, the earnings yield should be equal to CBY, which is the current Moody's Investor Services A-rated corporate bond yield. So how is this different from the Fed model? Here, at least default risk is built in. With the Fed model, we are looking at government bonds, so there is no default risk. Now we are talking about corporate bonds, so we still don't have equity risk, but we do have default risk. So that is this yield minus a coefficient called B, which generally is, at least empirically, it has been shown that it's about 10%. It measures the weight the market gives to 5-year earnings projections, just memorize that, multiplied by the growth rate, G, plus some residual which has an expected value of 0. So simplistically, you have this expression. Now, what does this say? This is saying that the earnings yield should be equal to the yield on corporate bonds, which is CBY, minus B into long-term earnings growth rate. Okay, now what should the PE then be? So if this is what the justified earnings yield is, then what's the justified PE? The justified PE is simply equal to 1 over CBY minus B into long-term earnings growth rate. All right, just the reciprocal. Now notice that consistent with valuation theory in Giardini's model, higher current corporate yields, so if the corporate yield is relatively high, that means interest rates are relatively high. That would mean that stock prices should be low. So a high number for the yield on corporate bonds would imply a low justified. The other point is that a relatively high growth rate will imply a high PE. So in that sense, this particular model is reasonably consistent with general valuation theory, though a limitation is that it's not taking into account the equity risk premium. It is taking into account default risk because the corporate bonds do have default risk built into them, but the equity risk premium is not being taken. And then whether the stock market is overvalued, undervalued, you can use the same logic that we used in the earlier Fed model. I would not get too hung up with this material because it's not explicitly mentioned in the learning objectives, but it is emphasized in the example, so I would know at least the basics that I have covered in this lecture. All right, this is critical. Valuation relative to own historical PEs. So we've talked about valuation relative to peer companies or the industry. We've talked about valuation relative to the market. Now we talk about valuation relative to a stock's own historical PE ratios. And we look at the example of Honda Motor Company. All right. So state a benchmark value for Honda's PE. You are looking at historical data. So what should the benchmark be? Mean or median? We don't have any huge outliers, so it could be either. You can actually come up with numbers based on both. There's no hard and fast rule. Generally, one is more inclined to use the median, but you can also look at the mean. So either could be a benchmark. Given EPS for the year ended 2008, so if the EPS for the most recent year, 2008, is given, calculate and interpret a justified PE or justified price for Honda. How will you come up with a justified price? You will say that, look, this is the earnings number. If you take a median number, which makes our calculation easier, you can multiply the two and come up with the justified price. Justified based on what? Justified based on the historical PE of this particular company. And then compare that justified price with the stock price of 3590. So does the stock appear to be overvalued or undervalued if you use the median as the benchmark? Overvalued. Yeah, the stock appears to be a little bit overvalued. So if you actually do the calculations, with 10, you have 3305 as the justified value. If you use 10.6, then it is a little higher. So the stock's recent price is 8.6% more than the justified price. With median, it's 2.5% higher. So the stock just seems to be slightly misvalued. All right. Another point is PEs in cross-country comparison. When comparing PEs in different countries, the analyst should be aware of the following effects that may influence the comparison. The effect on EPS of differences in accounting standards, comparisons without analyst adjustments among companies preparing financial statements based on different accounting standards may be distorted. Such distortions may occur when, for example, the accounting standards differ as to permissible recognition of revenues, expenses, gains, etc. So this is classic FRA material. The effect on market-wide benchmarks or differences in their macroeconomic context. Differences in macroeconomic context may distort comparison of benchmark PE levels among companies operating in different markets. The biggest item here typically is inflation. So in the context of emerging markets, inflation is high, and that is going to impact the PE ratio. So given that inflation is a reality that keeps coming up, let us look at some interesting formulas. Assume a company with no real earnings such that its earnings growth can result only from inflation, will pay out all its earnings as dividends. So based on the Gordon growth model, what is the value of the share then? So P naught is equal to E1, but E1 is simply given by E naught into 1 plus the inflation number divided by R minus G. What is G in this context? If the only growth is coming from inflation, so you have divided by R minus I. So is this a new formula? Not quite, because you've seen this before. All you are doing is replacing growth with inflation. Suppose the company has the ability to pass on some or all inflation to its customers, and let lambda represent the percentage of inflation in costs that the company can pass on through to revenue. In other words, let's say that there is a certain inflation rate. If lambda is 80% or 0.8, then this is saying that for every dollar increase in input prices, a company can pass on 0.8 to customers. Okay, then what happens to our equation? Then we say that what does E1 become? So in this example, earlier we said E1 is equal to E naught into 1 plus I. Now, what will you have? Now you will have E naught into 1 plus lambda times I. Why? Because now at what rate is your earnings going up? Is it going up purely at the inflation rate, or it has to go up at less than the inflation rate? Less than the inflation rate based on lambda. If lambda is 0.8, then E naught is equal to 1 plus 0.8 into inflation divided by R minus G. What's your growth rate now? Is it inflation or it is actually lambda I? Okay, so same equation. Just instead of growth you have lambda I. Now let's introduce the real rate of return, and we'll call that rho. The value of a share and the justified PE can now be expressed as follows. So this is P naught is equal to this expression. Now what you can do is say the following. Actually, if you look at this, this we are writing as E1. So this same expression can be written like this. It's P naught is equal to E1 over, or you can just bring the E1 over here, and now this is our ratio. 1 over the R minus lambda I, using some basic algebra which is shown over here, can be rewritten as the real rate plus 1 minus lambda into I. What I would say is, once in your life you go through this algebra and convince yourself. After that, you just remember this relationship which says that the PE ratio for a company that doesn't have any real growth and can pass on lambda percent of the input inflation to customers, for that company the PE is given by this. So if you have a low real rate over here, does that create a high PE? Yes. Remember, a low interest rate means a relatively high PE. So that is given by rho. In a country with no inflation, their rho is equal to the nominal interest rate R which you use. So you can see that in this relationship. If inflation is 0, then you simply have 1 over rho, which is 1 over R. If lambda is equal to 1, then what do you have? Then you also have 1 over rho. And what's the economic justification? if a company can pass on all inflation to its customer, then should inflation impact the value of the company or the multiple? No. So that also helps you explain why you have 1 over lambda. So based on the business justification, hopefully you can memorize this formula. If you like algebra, then you can quickly derive the formula. If you like to memorize formulas, then you just box this and memorize it. All right, now let's continue with the same example. I want to see whether you actually remember the formula we just talked about, and you compare these two companies, M and P. So let's look at part 1, A and B. If you calculate the justified PE for M, just plug in the numbers, you get 22.2. And then company P, it is similar except that the inflation number is lower. The lambda is the same, but inflation, the cost inflation is only 2%. And notice that with a lower inflation number, the justified PE is higher. So this illustrates an important point. If a company cannot pass on all inflation to customers, then clearly lower inflation is better. Lower inflation allows the company to have a higher justified PE. Then question 2 also illustrates an important point. Here, both companies face the same inflation number. Company M can pass 90%, P can only pass 70%. So which company will have a higher justified PE? Obviously the company which can pass on a higher percent. And when you do the calculations for 2A, you should get 27.8, and for 2B, what you should get is 20.8. Next point is to use PEs to obtain terminal value in dividend discount models. And this is very straightforward. It is something you've also seen in earlier readings. The first thing to do is determine the benchmark value. And for the benchmark value, you might either use the median industry PE or the average industry PE or the average of the company's own past PE. So what exactly does this mean? Let's say that you are doing a valuation at time 0 and you can predict the growth rate over the next 3 years. Let's say that this is relatively high growth. Then what do you do at year 3? We've talked about this before. What you can say is that at the end of year 3, you expect the industry PE to be a certain number. Let's say you expect that number to be 10. And say you are coming up with that number based on the median industry PE. So this 10 then becomes your benchmark. And then what do? You then say, okay, you expect the earnings over this period to be a certain number for your target company. Okay, so notice that here I'm saying trailing terminal PE. So if you are doing your valuation, your terminal value at the end of year 3, and you use earnings for year 3, which is this number over here, then you actually take the terminal PE, or this would be the trailing terminal PE, and I hope you see why it's called trailing terminal. Terminal because it's helping you come up with a terminal value. Trailing because relative to 3, you are taking a trailing PE. So obviously you will then multiply with EN. N in my example here is 3. Okay. Or if you want to come up with an estimate for year 4, but you are coming up with a valuation at the end of year 3, then you would take the forward PE, so an estimate of the forward PE, which might be say 8, and multiply that by earnings for year 4. The terminal PE can also be estimated using the Gordon growth model, and we've done this enough times. So if we do the same scenario, year 3, how do you do the Gordon growth model? If you have earnings for year 3, then what's the value here? So this would be equal to E3 into 1 plus G, because remember, value over here means that you really need the estimated earnings for year 4 divided by R minus G. And to test whether you've really understood this or not, you need to do this. You cannot pass the exam without being able to solve a question like this. So for part 1, the answer that you should come up with is 42.9. The reason is you are given E3, earnings for year 3, which is $3. And then the industry average PE is 14.3. It's not stated explicitly, but this is the trailing PE. So you multiply 14.3, the trailing PE, with 3 and you get 42.9. And then what if you use the Gordon growth model? So here is what you do for the second one. Remember that the growth rate is equal to the retention ratio, 0.55. It's 1 minus 0.45 into the ROE. So growth rate is 0.0715. The value at time 3 is equal to the dividend at time 4 over R minus G. Dividend over here for year 4 is equal to earnings for year 4, which is 3 into 1 plus the growth rate, multiplied by the payout ratio, which is 0.45, divided by R minus G. And here you should get 50.76.